Hello, happy Monday, and welcome to Fidelity Connects. I'm Pamela Ritchie. 3.5 weeks from now, September 17th, is a very live Fed decision day. At the Jackson Hole Symposium last week, U.S. Federal Reserve Chair Jay Powell opened the door wide to a rate cut at that meeting. However, a marked and somewhat expected shift in tone to the labor side of the Fed's dual mandate was present. The word curious was used to describe labor market traits at this time. Discussion of a cut in September lit equity markets on fire through Friday's trade, a bit flatter here today. But what ultimately do moves in the long bond space tell us, some of the other asset classes? Our next guest says with all of the moving pieces in today's marketplace, the best strategy might be to stick with what you have deployed and not make any sudden moves. Joining us today to help put the macro themes, including massive earnings releases later this week, into perspective for you and your clients is Fidelity Director of ETFs, Andrei Bruno. Welcome, Andrei. Great to see you.
Always great to be here. Thank you for having me.
Happy Monday to you. Well, that was quite, there were some fireworks out of the discussion on Friday, out of the Jackson Hole meeting. Let's have you kind of give us your take initially on that. He did swing to the labor side.
Yeah, I was a little surprised by it, to be perfectly honest, because we roll back to the last FOMC meeting, and he took a very hawkish tone during that meeting.
Not long ago, July.
Not long ago at all. There was reference to the labor market being, decent. There was a lot of reference. There was a little bit more focus on those particular notes from Jay Powell surrounding inflation, still running a little bit hot. I think PCE is still running around the 2.7 range right now, which is their preferred measure for inflation. It's what the Fed looks at in terms of effectuating their monetary policy. So there was, as you mentioned, a big shift over to the labor market. So if we take a look at the labor market, nothing's screaming, if you take a look at the headline unemployment number, it's still fairly reasonable within very good numbers, very good numbers actually. If you take a look at the U6 number, which is another, it's called the underemployment number. So it's a
more equitable look at the.
It includes a few more people. Yeah. It includes discouraged workers, folks working part-time who wish they could be working full-time, and stuff under the hood there. That's also a fairly reasonable number. We haven't seen large upticks in that either. If you take a look at the jobs numbers, the ADP numbers, or the non-farm payrolls, which is a big number that the market looks at, we haven't been adding a ton of jobs to the labor market, but we also haven't been seeing a lot of people losing their jobs either. So it's in this
kind of... The revisions didn't look so good, as we know, and that was a real...
The revisions weren't great, agreed. If you take a look at, some JOLTS numbers, some job opening numbers, as mentioned, those are not moving up. So we're not seeing new jobs. So it's in this interesting spot where the main numbers are looking okay. Some stuff under the hood doesn't look super rosy, but not, doesn't look bad either. Just as a reminder though, employment is a lagging indicator. So when we start seeing signs in the labor market, it's already, things have already happened. Things have already gone bad. What we also have to appreciate is, I think Chairman Powell has some access to some data that perhaps the rest of the market hasn't seen.
Do you think he might be able to see something that we can't
see? So
that's
to put my tinfoil hat on, but maybe he's seen some stuff that we haven't seen under the hood. So, but it was interesting seeing that shift. To be honest, I wouldn't have expected it. It certainly does bring September well into play. The market was already pricing in, but that's, we've seen those expectations, the market pricing expectations of a cut edge up to 85% probability now for September. The other question at hand is, if we're going to get that one cut, are we going to get another cut this year?
Right.
And the market is pricing it in, so we'll see.
If you go back to this time last year, we didn't know it at the time, but a 50 basis point cut was around the corner, which is a big one. How different is, there are different people in charge of the world today also, but how different is the environment to cut into at this stage?
Well, we hit some all-time highs not long ago, maybe a couple of weeks ago or a week ago, on equity markets. The labor market is, okay. Inflation is a little bit hotter. So I think there's going to be a lot of questions around, should we be cutting interest rates when the core inflation metrics is 70 basis points above the target rate? Now, we have had some Fed speakers come out in Jackson Hole who had more of a hawkish tilt, saying, our inflation's still running hot. We don't necessarily need to be cutting interest rates right now. So, obviously they have to pass the vote. So will there be enough members voting where Chairman Powell, it sounds like Chairman Powell might be voting in favor of an interest rate cut in September. It'll be interesting to see the rest of the committee. We do have some speakers this week, 2 non-voting members and 1 voting member, so it'll be really interesting to see what they have to say coming out of Jackson Hole. And then we can have a better idea of where we might land in September. Obviously, we have to overlay the political pressure here.
This is that some commentators have said that the shift in his tone was due to being a bit sat upon and to find a reason to cut. But I mean, that doesn't necessarily mean it's true. It's just another argument.
Yeah, I mean, obviously brings into question, the independence of the Fed if they're kowtowing to political pressure here. So, it'll be interesting to see if we do get the cut. I mean, it sounds like the market's pricing it. It sounds like Jay Powell signaling it. I don't know if I would want to bet against it at this point.
That's interesting. Okay.
It will be interesting to see the wording around the meeting and see what they have to say, whether it's a one and done or whether it's opening up the door for another cut in December. It'll be interesting to see, but it'll be interesting to read the details there. You
spent a significant amount of your career up until now, or before now, sitting at a bond desk, having lots of conversations with bond traders. You were a bond trader. What are the conversations at bond desks right now like? You still spend a fair amount of time chatting to people.
Yeah, I mean, I think rates is a big story now because we have so many bogeys in terms of the rate market. What's the Fed going to do? Tariffs is obviously a massive overhang on the bond market in terms of, what's it going to do to inflation? What's it going to do to growth? So, I mean, if we think about the long end of the yield curve, there's probably 3 main themes that move the long end. It's in long-term inflation expectations, long-term growth expectations, and you see a lot of interest in the long end when there's, flight to safety. Obviously, people buy long bonds, sell risk assets, and buy long bonds. So we've seen kind of the belly and the long end move quite a bit this year, up and down. It moved up and then it's moved back down, and now we're seeing it move a little bit higher, since Friday. So there's been a lot of rates volatility, even over the last, 5 or so years since COVID. There's been a tremendous amount of rates volatility, which we, prior to that, post 08, rates volatility was probably non-existent. Yeah. So the market dynamics have shifted there with a lot of focus on interest rate volatility. So I'm sure all the rates traders on all the desks are keeping busy in these times.
I'm sure they are. Overlay the geopolitical discussion. Actually, there's a fair amount of resiliency in the bond market to geopolitical or some pricing in already. But that said, would the long bond story still come into play if there were some serious geopolitical stories to react to?
Yeah, I think ultimately we saw a lot of that around kind of the Ukraine invasion when it happened. We saw a lot of movement. At the end of the day, creates a lot of uncertainty. People don't know what to do. They start buying the long end. I think in terms of those risks now, I don't think the bond market is kind of looking at any contagion at this point. I think we're past that. Obviously, the risk is always there. But right now, that risk I don't think is in the forefront for rates traders right now.
Okay, that's really interesting. Just sort of what is the discussion. So let's get to just a couple of different data points that are well telegraphed and everyone knows are coming out. So PCE, you've got actually some massive earnings coming in this week on the AI front, but also CPI, another jobs report. All this happens before September 17th. Those are really interesting and obviously pivotal for the Fed's decisions. What else do you look at? I'm sort of interested in the data story right now. Seems to be one that is changing, actually. People are creating a bigger basket to collect data.
Yeah, I always like to keep a close eye on the consumer. At the end of the day, we're, Canada and the U.S. developed economies, so a large chunk of our GDP is that consumption, that CNM. If you think back to our Econ 101, consumption, investment, government spending, and net exports. Consumption is the number one indicator to look at there. So, for me, I always like to look, what's the state of the consumer? So number one, obviously, the labor market's important for the state of the consumer. Other things I like to look at are, as kind of, not canaries in coal mines, but stuff that gives us some indication in towards the health of consumers. What are delinquency rates on auto loans and credit cards?
In Canada or everywhere?
Canada and the U.S.
Okay.
Is primarily what I look at. And the reason I like to look at those metrics is, if we think about mortgages are the last thing folks default on typically, historically. People need a roof over the head. But those credit cards and those auto loans, you start to see those move first. So if we look at the United States and we look at Canada, it's been a similar trend. We've started to see those tick higher over the year. Mm-hmm. And why do I care about that? Now, ultimately, if folks aren't paying their loans, suggests to me they have less for consumption as well. And the next thing I look at is retail sales, which is where you'll see the consumption behavior.
Which we just got, yeah.
So in Canada, it's been a little not great. The headline number's been okay. You take the ex-auto figure, and it's been negative, I think, 2 or 3 times this year on a month-over-month basis. So it suggests some consumption slowing down here.
Could we be in a recession right now? Canada.
We could be. I mean, ultimately, we get the GDP numbers months later.
We don't know. But
We do need 2 consecutive negative quarters. We could, if you take a look at an economic activity perspective, there could be a case to be made that we're kind of already in a recessionary period. The U.S., I would probably say no. I think for the U.S., we're probably more kind of the late stage in terms of the economic cycle. But in Canada, it's very possible. So, the other thing I want to overlay as well to the consumer, is particularly in Canada, is our mortgage market structure. We do have a lot of renewals coming up this year and next year.
And banks are expected not to put as much aside for provisions for credit losses. What do you take from that?
So that's good news, and I think that shifted. That started shifting when we started to see cuts from the BOC, because I know last year there was a lot put aside. Loan loss provisions were put aside from the banks. So we're seeing a bit of a reversal of that to some degree. And again, I don't think you're going to see a wave of mortgage defaults, isn't what I'm suggesting. But it could hit consumption. Like ultimately, the cuts are going to help, but I think you're still going to see a good chunk of folks that are seeing an increase in their month-over-month mortgage costs. And where's that coming from? It's coming from consumption.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So there's more to say on some of these macro pieces. Arguably, AI earnings, or companies that are AI companies related to it, are pretty macro as well, depending on how much they are worth. So NVIDIA is coming out with earnings this week. It's really the commentary of how have we overspent? Has everyone overspent or overinvested in the AI trade? What say you to this? There's lots of different thoughts on this.
Yeah, I mean, I think long term, I think the AI trend is alive and well.
Is it the trend?
I'm biased to say yes.
Okay.
I'm very much in the AI camp. I think, if you had to pin me down on a time frame, I don't know if it's the next 3 years, 5 years. I talk to my friends in tech and they say it's moving at light speed pace, it's coming tomorrow. And then you talk to other folks and say, it's going to take longer. I'm not certain on the time frame, but I think it is going to revolutionize kind of industry. We're not just thinking the AI, like the tech names. I think it's going to have implications downstream for all areas of the economy. So I also think that's a great opportunity as well. So right now we can very much think about, the software developers of AI, the downstream hardware developers to support AI. But I think what the next trend in thinking about is, who's it going to affect in the broader economy, and how are companies going to be affected? If you think about it, you'd expect we should see some productivity gains.
Yes.
I also think that's a big opportunity for Canada as well. Our productivity growth's been a little bit sluggish. We always lag the United States, but I think it's been a little bit of sluggish here. So I think it's a really big opportunity for Canada as well.
Like almost as a leapfrog.
Well, I just think it's a way. We think about manufacturing in Canada. We haven't got a lot of productivity gains that have probably lost some. Since NAFTA years and on, manufacturing activity has been going down in Canada. But I think for us, it's a big opportunity. We have a very large knowledge-based economy here in Canada, and I think there's a lot of productivity gains to be had there. So I think hopefully we're in good shape to take advantage of that long term.
There's a great discussion about whether we have enough to power that and how we will power that. Actually, oil doesn't seem to be part of that conversation at all, really, but lots of other types of energy do. Do we have enough power at this moment, do you think, to do this build out?
Current infrastructure is probably not sufficient to meet those needs without a commensurate increase in prices. I think long term, and what a lot of folks are talking about now, is nuclear.
Yeah.
The only problem with nuclear, takes some time.
Quite some time.
It's not going to happen overnight. I think, 10, depending on the jurisdiction, 10 to 20 years to get a new reactor online.
China's moving very quickly on that, actually.
They've had some reactors in development for quite some time. So
okay.
I think, they do have a lot of coal power as well in China as well, which isn't particularly great for the environment. It isn't great for health either. Obviously, having a lot of smog up in the atmosphere isn't great for the general population either. And that's also another reason why I don't think we can rely on just fossil fuels to power the energy needs. Some renewables will chip in here and there. There's some base load issues with renewable, whether it's wind or solar. Obviously, you get a cloudy day or wind isn't blowing, so it's challenging for base needs to rely solely on renewables. But whether it's renewables or nuclear, I think they're both going to have a role in kind of powering the AI future.
It's exciting. It's really an exciting piece of the market. Okay, so with all of these different pieces that you're viewing right now and some trends and so on, ultimately, how are you seeing investors, the flows story? How are ETFs doing? I mean, they're actually in blast-off mode too.
ETFs was seeing tremendous growth this year. I think it might be the year's not over yet, but we're trending to be one of the best years for ETF growth on record.
Canada?
In Canada here. I think it's similar in the United States as well, but I don't know those numbers quite as intimately. Now, if we get down into kind of the nuts and bolts and where money's been going, it's been an equity-driven story this year in terms of flows. When we kind of drill down onto the equity flows, it's been an international story this year. It's been moderating a little bit in the past couple of months. If we think back to the tariff tantrum, we saw a lot of folks flocking away from the United States. There's a lot of uncertainty. So that's moderating a little bit right now, because if we take a look at equity market returns as well, year to date, international, Europe still outpacing, even Canada's outpacing the US. But if we take a look at the last 3 months, the NASDAQ and the S&P have been, the number one performers in terms of indices returns there. So we're seeing folks, focus a little bit more on the US now, but it's still international. If we take a look at July flow numbers, it was still international equity. Now there might be,
It's interesting, still in July, that was still going on. But because we keep hearing that money's flowing pretty quickly back into the US. So you're seeing both, essentially.
We are seeing both, and I think there's a few things at play there. I think early on in the year, obviously the tariff tantrum had a lot to do with it. I think valuations come into play as well. I don't think the United States is super expensive. If you take a look at a price to earnings, we are above historic averages, but we're not in tech wreck type valuation levels. If you take a look at the Magnificent Seven, valuations are expensive, but they're not crazy expensive. But if we take a look at Europe or EM markets or international markets broadly, they're a little bit more in line with historical average. So they are cheaper from a valuation perspective.
So layer in some of the factors themselves. So you mentioned late stage. The market's been performing as if it's in late stage, so we'll call it late stage. The factors that work, their momentum certainly actually has been one of the names of the game. Historically
speaking, in late stage, the factors focus on in the U.S. have been momentum, as well as
quality.
Yeah, quality in there as well. And I mean, if you take a look at year to date, I think value might be just outpacing it a bit. But if we think about that tariff tantrum, that's when kind of value was shining a little bit there.
Right. People came out of that into value.
Exactly. But if we look at the last 3 months, the textbook stuff has been working.
Amazing. So is something that we also see, or is there a way to capture it in Europe? Like you just mentioned that the first half of this year of everything that's gone on has been quite an international trade. Do you see some of those factors at play do we apply those to European trades?
We certainly can. We just have to do the analysis of where is Europe right now.
Yeah.
So, arguably Europe's a little bit ahead of, North America in terms of where they are in their cycle. They're probably coming up and out of kind of their slowdown period. So different things would work, kind of in the early stages to recessionary stages, I would say.
They've had a lot of cuts, actually, when you look at their central banks.
Yeah, I mean, Christine Lagarde, the head of the ECB there, had mentioned recently that she was indicating that they seem to be done on the cut front. So maybe there's a little comfort there. And if you take a look at the economic data underpinning Europe as well, it is looking a little bit better as well. So it might become a little bit more of an interesting area to take a look at.
It's so interesting how this is coming through. Give us a sense of, I mean, we can go into the different products themselves. You help create these at Fidelity. This is an area that that you're intimately involved in making sure they get off the ground. Without asking you specifically, is there a new launch coming? Is there a new launch coming? You're working on some things?
What I'll say broadly is what we've been seeing, we've seen a lot of the flows over the last 2-3 years. We've seen the active, so actively managed mandates growing at a very rapid pace. So what we're seeing is a lot more products come to market that are actively managed. If we rewind back 20-30 years, it was an index passive market.
Right.
That's what
an ETF was.
That's very much changing. So, we're seeing a lot of interesting bespoke products that are utilizing derivatives. We're starting to see a lot more active products come to market. Personally, we've launched quite a few active products. Being Fidelity, we pride ourselves on being an active shop, or an alpha shop, I should say.
Yeah.
So we've certainly taken part in that trend, and we're continuing to see that space grow tremendously.
So come back to kind of the U.S. exceptionalism story there, and how that ultimately is being expressed in terms of, actually give us a sense of how much money is being made in this market right now in terms of the ETF market. How much is it growing?
I don't know the exact growth rate, but it's growing rapidly. And I think the one thing I'm thinking about right now as well is, and a lot of questions clients ask us is like, what should we do right now? What should we change?
Yeah.
And for me right now is I'd be adverse to doing any massive changes within the portfolio, because
no huge conviction.
I don't have any. So things I want to look at is what can break.
Yep.
That's probably one of the things being in FX and foreign exchange is you're always thinking about what can break. You're kind of always a perma bear. What can go wrong? So that's one thing I always try to look at is what can break. So one thing I like to look at obviously is credit markets. What is the credit market telling us? You'll often see cracks in the credit market long before you see cracks in the equity market. And when you take a look at credit, everything talking about corporate credit, where you're looking at leveraged loans, high yield credit, or investment grade credit, is spreads are extremely tight, whether you're looking at Canada or the United States. So we're not seeing any stress as of yet in the credit markets there.
But just the fact that they're so tight, sort of, what does that mean?
Your risk there is when they're so tight is that maybe they can only go in one direction. There's certainly still more room to run. They can get a little bit tighter. But when you think about your risk reward, it certainly comes into the calculation. If we do start seeing cracks, whether it's in the economy, at the end of the day, whether there's going to be defaults or not, folks are going to be funding, either, raising cash to buy either, money markets or treasuries. That funding typically comes from high yield bonds or leveraged loans and certain areas of the market that hold more credit risk. So there's always that risk there.
So that is always kind of something that's there. It's interesting to look at the equity markets right now also in terms of, we'll come back to sort of the earnings this week, but the idea of the equal weighted market, and then also if you look at companies that make the most and they're cap rated in that particular, where are the opportunities going forward? You said AI is sort of the theme, so one would think you might stick with the cap weighted, but what about the 490 or 93 other stocks?
Yeah, so what's interesting there too is if you take a look at the PEs, the PEs of the cap weighted versus the PE of the equal weighted is much different. The PE of the equal weighted is actually around historical averages. So certainly from a valuation perspective, the other 493 names are cheaper relative to those Mag 7s. Now, I don't know if I would say, right now the trend is quite favorable on the momentum train. And by proxy, the Mag 7, it's been working. I think what would give me pause and for a reassessment is really these NVIDIA earnings.
Okay. One way or the other, is that sort of the idea, or?
Exactly. So the question is do we think the market's going to broaden out a little bit?
Yeah.
Are there opportunities elsewhere? Yeah, in fact, though, if you take a look at year to date, industrials have been doing decently well from a GIC sector perspective in the United States as well. So there's a little bit of widening out or broadening out in the market, but right now the theme still seems to be kind of with the momentum.
And on sort of the bond side of one's portfolio, if we want to call it that, or even just a multi-asset approach to things, Within the bond market, what would you do? What would the moves be if there were? You're kind of saying actually don't make a lot of moves in terms of conviction, but what would you want to make sure you're covering off?
Yeah, I'll tie it back to flows as well. In terms of the ETF market, we've been seeing all the fixed income flows, not all the fixed income flows, but a lion's share of the fixed income flows going into just broad market diversified.
That's interesting.
So diversified across, within sectors, so whether that's investment grade high yield, treasuries, but also within geography as well. We've also been seeing a lot of money flow into Canadian fixed income as well. Would probably be the second largest category there.
Why is that? Less indebted?
I think we're kind of through. We've got our cuts out of the way.
Okay.
I think so. So maybe there's just less worry that we're going to continue to see some pressure on the yield curve. Actually, that would be the opposite. Actually, in the U.S., you'd think if the cuts, you'd want to pile into it, but the long end of the curve has not been moving favorably in the U.S. What I will say though about the broadening out is, interest rates in the U.S. are still high, so you're still clipping a decent yield over there. There is a lot of uncertainty around where our yield's going to be in the U.S. Credit spreads are super tight as well. So there's obviously that risk that we could see a widening out in credit spread there. So just being diversified, you get your nice yield in the U.S., but you can diversify away some of that potential credit risk, some of that noise in the rates with regards to the U.S. Treasury yield curve as well.
Really interesting. So if investors are deployed in a certain way, they have their strategy. The discussion right now seems to be, even though there are all of these moving parts and potentially all these different opportunities, is to kind of stay put. Is that part of what we're hearing?
Yeah, for me personally, I'd like to see some sort of catalyst to change, some sort of risk to make me reassess. And right now, I don't see any big catalysts at this moment. So personally, obviously do your due diligence. Obviously, stay focused out there. We've got a lot of data this month. We've got obviously the Fed in September, so there's a lot of moving parts right now. Obviously, tariffs remain to be an overhanging risk here. It seems every day there's new headlines about this deal moving forward, this deal breaking down. So there's obviously still a lot of risks surrounding kind of the global economy. But as of now, I kind of for me, I personally like a little bit of a holding pattern.
That's very comforting. I think you've just put a lot of people at ease, and it's wonderful to have this week kicking off with much of your wisdom. Thanks for joining us, Andrei Bruno.
Thank you so much for having me.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.